In most cases, it's mathematically most tax efficient to have the lowest reasonable compensation you can substantiate, because the tax benefits of an S corporation come through the K-1, not your W-2. In some cases, however, a larger W-2 is more tax efficient, like in the case of claiming the self-employed health insurance deduction, or qualified business income deduction for high income earners, or the desire to make larger retirement contributions. We really need to analyze all four criteria to make the best recommendation. That being said, reasonable compensation is going to be equal to or greater than what you would pay another person to do your job, otherwise known as like a job description. Number two, it should be greater than a livable wage for you, minus any other sources of income that you have. And it should be less than any cash or property that you distributed from your business. In compensation planning, we're seeking to determine the optimal W-2 because as an S Corp owner, you take income from your business in two ways. First, you take income on a W-2 as an employee for your individual time and effort devoted to that business. And the second way you take income is on a K-1 as the shareholder of the business for your allocation of capital and other resources. We consider four main areas when determining your optimal W-2. Number one, reasonable compensation, which is an IRS requirement. This is especially scrutinized because most of the tax benefits of an S corporation actually run through the K-1. Number two, self-employed health insurance premiums, because as an S Corp owner, you're able to take an above the line deduction for your health insurance premiums, but only if your wage is at least that much. Number three, the qualified business income deduction under Section 199A, which is commonly referred to as the 20% pass-through deduction, because for some high income taxpayers, company-wide wages can be the limiting factor. And then number four, your desired retirement contributions, because the amount you can contribute to a qualified account is always a function of your wage. In this presentation, we'll cover the first two because the second two are complex enough to warrant their own presentation. What is reasonable is subject to interpretation, but the IRS does lay out some guidance. Your wage comes from the personal time and effort devoted to the business, and your K-1, which are the taxable profits of your business, are generated through the allocation of capital resources and through the efforts of your employees. Reasonableness also means that you don't have to run yourself a W-2 if you don't individually derive any cash, property, or benefits from the business. This protects the business in case it needs to preserve its capital resources, like in the case of a loss year or in the case of a predicted large capital outlay. The major considerations when determining the reasonableness of your W-2, and these come from the IRS's audit techniques, are don't be the lowest paid employee in your business, especially if there's other employees in your business that are doing a similar job to you, like you're an attorney and you have attorneys that are getting paid more than you that work at your firm. Number two is going to be your time devoted to the business. On the extreme, if you spend zero time and you're just an investor in the business, you don't have to run yourself a W-2 because you don't spend any time in that business. Number three is going to be your level of education. In an audit, the IRS agent is going to ask what your level of education is, and the expectation is that somebody who didn't graduate high school deserves a lower wage than somebody who got a master's degree. Okay, and then finally, livable wage, which is something that the IRS uses to try and figure out if you're trying to hide income. If you have large personal expenses like a mortgage, education, kids, and a family that you support, and then you have a very low wage, or you're trying to say that you're not taking any cash or property distributions out of your business, that's not going to pass the smell test in an audit. And so livable wage is also a consideration. In practical terms, we're trying to determine the market rate for your services rendered to the business. In order to do that, we can access a database such as Robert Half's salary guide, find a job title that best fits your day-to-day, and adjusting for geographical location, produce a number that we can support. A technique occasionally used in an IRS examination is going to be livable wage. And so basically what the IRS does when using this technique is they look through your personal expenses to determine if the income that you're taking is reasonable as it's compared to what your livable wage would be. This is usually used to find taxpayers who might be skirting tax and living off of cash, but it's also useful to know that this technique exists in order to determine reasonable compensation. Okay, so if you don't take any cash or property from the S corporation, then you don't need a W-2. In an audit, if the IRS finds any distributions, loans to shareholders even, or any property that you've taken out, or even benefits that you've taken out, they may try and recategorize that as wage. Okay, so even if your business isn't profitable in the current year, it might still be beneficial to run a W-2 in order to take the self-employed health insurance deduction, which is an above-the-line deduction on your individual tax return. That amount is limited to either the self-employment income that you have or the W-2 income that you have. Luckily, health insurance premiums are not subject to any Social Security or Medicare tax. And that being said, most business owners don't do this correctly. It's actually supposed to be added to your W-2 in box 1, and then it's not going to be added in box 3 or box 5 because that's Social Security and Medicare. So there's really no downside to adding this to your W-2. And like I said, most business owners aren't doing this correctly anyways, but it is a reporting requirement by the IRS. In most cases, it's mathematically most tax efficient to have the lowest reasonable compensation you can substantiate, because the tax benefits of an S corporation come through the K-1, not your W-2. In some cases, however, a larger W-2 is more tax efficient, like in the case of claiming the self-employed health insurance deduction, or qualified business income deduction for high income earners, or the desire to make larger retirement contributions. We really need to analyze all 4 criteria to make the best recommendation. That being said, reasonable compensation is going to be equal to or greater than what you would pay another person to do your job, otherwise known as like a job description. Number 2, it should be greater than a livable wage for you, minus any other sources of income that you have. And it should be less than any cash or property that you distributed from your business. This presentation was created to support our comprehensive tax planning service, where we curate strategies to assist taxpayers in reducing their tax liability. We do this by analyzing their business, real estate, and individual activities and determining the optimal structure, optimal accounting method, available tax deductions, and available tax credits. Then we prepare a summary of estimated tax savings and effect on global cash flow to assist our clients in determining which strategies to pursue. Finally, we coordinate the action items needed to actually achieve these savings. If you're interested in learning more, please schedule a call with us. Current clients, please reach out to your partner or accountant, and all others can call our office to schedule an intro call.